Welcome to the Deep Dive. Today we're going to give you a really nuanced look inside Freeport-McMoRan, or FCX, the big global copper and gold producer. We're going to dissect their Q3 2025 results to get at this really remarkable strategic tension we found.
That tension is absolutely the core of this, isn't it? I mean, this is a company that calls itself foremost in copper, focused on powering progress.
Right.
And yet their Q3 shows this incredible high-stakes balancing act. They're managing really robust financial growth, but at the same time, they're coping with a truly unprecedented operational catastrophe.
So let's start with that strong financial picture because, yeah, on the surface, the numbers look great. If you compare Q3 2025 to last year's quarter, revenues picked up a bit from $6.8 billion to $7 billion.
But the real story, is the bottom line. That's where you see the market conditions really hit home. The diluted net income per share, it jumped substantially. We're talking from $2.36 to 46 cents.
Wow.
It's a powerful signal of profitability, but like you said, that's only half the story.
Exactly. Yeah. Because that bottom line success is happening in the exact same quarter that saw a devastating mud rush at their main operations in Indonesia, PT Freeport Indonesia. Yeah. So, yeah, we need to figure out how they pulled off that kind of profit with such a massive disruption going on.
Okay, let's unpack that. Segment 1, the price effect. So revenues and profits are up, but, and this is the key, their consolidated copper and gold sales volumes actually went down significantly. Yeah. So how do you sell less stuff and make more money? It seems like a total paradox.
It's purely a function of the market acting as this huge financial shock absorber for them. The copper and gold markets were so strong that every single pound of copper, every ounce of gold they did sell, they sold for a much, much higher price.
And when you say higher prices, let's get into the specifics because these numbers are really the engine behind their whole Q3 success story.
They absolutely are. So for copper, the average price they got was a solid $4.68 a pound. That's up from $4.30 a year ago, which is nice.
But the real difference maker was gold. That's a huge co-product from their Indonesian mines. They got an average of $3,539 an ounce.
$3,500. That's startling. Compared to what, last year?
Compared to $2,568 an ounce in Q3 2024. That near $1,000 jump for every single ounce of gold was just monumental.
And without that spike, the drop in volume would have just cratered the whole quarter. The sales numbers really show how bad the operational problems were. Consolidated copper sales dropped from 1,035 million pounds down to 977.
And just look at the gold sales volume. I mean, that's where you see the full force of the disruption. It plummeted from 558,000 ounces down to only 336,000.
That's nearly a 40% cut in the physical gold they moved.
A massive cut.
And yet, overall profitability surged. It's just an incredible testament to the power of those commodity prices.
It really is. And, it's worth mentioning the costs, too. In their other operations, their cost control was still really tight. Consolidated unit net cash cost for copper stayed stable, right around $1.40 a pound.
But there's a catch there, right?
A huge catch. We have to stress that that number explicitly excludes the massive idle facility costs from the incident, which brings us right to segment 2. That underlying efficiency is impressive, but it's just completely overshadowed by the extraordinary costs of managing the disaster at the Grasberg Block Cave mine. This all happened on September 8th, 2025.
And this was a genuine disaster. Yeah. The company itself called it an unprecedented event. It was a sudden, massive collapse, a mud rush of about 800,000 metric tons of wet material.
It's a staggering amount.
And we have to start by acknowledging the human cost here. Tragically, this incident resulted in 7 fatalities.
Yes, it's so important to remember that behind all these financial figures and operational stops, there's a very real and tragic human cost. The immediate response was, of course, to suspend all mining to focus on recovery, which took almost a month.
And the immediate financial hit that PTFI recorded in Q3 from that mud rush was substantial. What was the total?
The total was $195 million.
And just to give you a sense what that covers?
Well, $152 million of that was just for idle facility costs. Basically paying to keep the lights on and staff ready while the mine was shut. That other $43 million went to the actual recovery efforts.
So almost $200 million just vanished from the quarter's earnings for disaster management.
Exactly.
And the effects are still being felt. What's the operational status now, especially for their new downstream processing facilities in Indonesia?
The whole system is it's backed up. The smelting operations, including their brand new facilities and the older PT smelting, they're all on standby. They just aren't getting any concentrate from the mines.
So even the unaffected mines can't get product out?
Well, some of the other underground mines, like Big Gossan and the DMLZ, they did restart in late October. But the really critical one, the highly impacted Grasberg Block Cave mine, is still offline.
And that timeline for Grasberg is crucial for their future. I mean, that mine is a cornerstone of their supply. This isn't a quick fix.
Not at all. The current outlook suggests a phased restart and ramp up for Grasberg will only begin sometime during 2026. And on top of that, they've signaled more charges are coming. No impairment in Q3, but they expect to write off a lot of damaged infrastructure in the fourth quarter.
The disruption was so bad they had to declare force majeure. For our listener, what does that actually mean in this context?
It's a legal notice. You're basically telling your customers that you physically cannot meet your delivery contracts because of an unavoidable catastrophe. It's a very clear signal of just how severe this operational choke point really is.
Okay, so we've dealt with the immediate shock and the cost. Let's pivot now to how they're planning for the next decade. Segment 3 shows this rapid shift from crisis management in one place to aggressive, tech-focused expansion everywhere else. It almost feels like the disaster is pushing them to diversify even faster.
Absolutely. When you experience that kind of operational risk firsthand, it's a powerful incentive to shore up your supply chain and find efficiencies somewhere else, and fast. The internal growth story is all about technology, especially new data analytics they're applying to their leaching processes in the U.S. and South America.
And this isn't just talk, right? They're already putting numbers on how successful these initiatives are.
They are. These new techniques delivered 154 million pounds of extra copper in just the first 9 months of 2025.
Wow.
And that's just from finding smarter ways to get metal out of their existing rock. Their target for 2026 is an ambitious 300 million pounds of copper a year just from these programs.
And we're seeing specific, tangible innovations being rolled out.
Exactly. Like at their Morenci mine in the U.S., they're doing large-scale tests with an internally developed additive, even applying heat to boost copper recovery. Plus, they hit a huge milestone in Arizona. The Baghdad Hall truck fleet became the first major mine in the U.S. to go fully autonomous in October.
That's a big deal.
It shows a deep commitment to high-tech, lower-risk operations, especially in their home markets.
Speaking of the U.S., let's look at the huge expansion projects that are supposed to underpin their future growth. The Baghdad, Arizona project is just massive.
It is. And this is where you see them strategically hedging against the kind of volatility they just saw in Indonesia. They're looking at a project in Baghdad that would more than double the concentrator capacity there.
Aiming for what? An increase of 200 to 250 million pounds of copper per year?
That's the target.
Wait a second, though. You mentioned the Baghdad project needs about $3.5 billion in capital. Given the disaster they're still managing and the money they need for the Grasberg restart, is now really the time for that kind of massive spending?
That is the crucial question. And the answer, I think, lies in the reserve life. The Baghdad project is backed by an enormous, over 80-year reserve life.
80 years.
So by investing that $3.5 billion now, they're using their strong balance sheet to lock in decades generations, really, of geographically stable production. It's a strategic bet on long-term stability away from that geopolitical risk.
And they're placing a similar bet in South America at the El Abra mine in Chile.
Yes, a very similar bet. They're defining a vast sulfide resource there, estimated at 20 billion recoverable pounds of copper. This project could add an incredible 750 million pounds of copper a year to their capacity.
That's almost as big as their entire U.S. production base.
It's a game changer. And they're planning to file the all-important environmental impact statement in the first quarter of 2026.
Okay, let's circle back to Indonesia now. Looking past the cleanup and more toward the long-term partnership with the government, which really dictates their entire financial future there.
Right, and that relationship is defined by two key things: downstream integration and mining rights. On the first point, PTFI just achieved full downstream integration this year. Their new smelter produced its first copper in July, and the precious metals refinery has been ramping up.
Even if they're on standby right now.
Exactly. They're vital national assets. And that plays into the second point, the mining rights extension. This is essential because of the sheer scale of what they have planned next.
Goose and liar.
Precisely. They're in advanced talks with the government to extend their operating rights beyond 2041. And here is the key detail for you to understand. FCX expects to keep its roughly 49% ownership stake through 2041.
And then what happens?
But starting in 2042, they have to transfer an additional interest, which will drop FCX's stake down to about 37%. That timeline is absolutely critical when you look at the value of their biggest upcoming project, Kusing Liar.
And that mine is truly monumental. Tell us about that timeline.
It's expected to produce over 7 billion pounds of copper and 6 million ounces of gold. and the production window, primarily between 2029 and 2041. It's a massive $4 billion project designed to max out production just before that ownership structure changes.
That 2041 date seems very, very strategic.
Yeah.
And before we move on, we should just note one clear casualty of the mud rush incident was their environmental plan.
That's right. PTFI's plan to switch from coal to natural gas to cut emissions has now been deferred by 18 months. It just shows how these operational crises can have really wide-ranging, non-financial consequences. So we've covered the crisis, the high prices that saved the quarter, and these aggressive growth plans. Let's look at the financial foundation that lets them manage a disaster while planning to spend billions.
The balance sheet, as of September 30th, is remarkably solid. Total debt is $9.3 billion, but that's backed by $4.3 billion in cash. But it's their approach to net debt that really gives you insight into their discipline.
The reported net debt figure is only $1.745 billion, and this is so important because it's well below their own internal target range of $3 to $4 billion.
And the reason it's so low is because they exclude certain debts from that calculation, right?
Exactly. They exclude the $3.2 billion in debt that's specifically tied to building those new downstream facilities in Indonesia.
So, effectively, they're walling off the debt for that massive strategic investment from the core operational debt. It makes the core business look extremely lean and healthy.
Precisely. And that strong position allows them to keep up their shareholder returns. They're still paying $1.15 per share quarterly dividend, which is a mix of a base and a variable performance-based payment.
And they still have huge capacity for more returns, with $3 billion still available under their share buyback program. Looking to the end of 2025, they're projecting huge operating cash flows, something like $5.5 billion.
And that $5.5 billion figure is based on some very specific price assumptions for the fourth quarter. Copper at $4.75 a pound and gold at $4,000 an ounce.
$4,000 for gold.
The size of that projected cash flow just underscores how incredibly sensitive their profitability is to the market.
It's so highly leveraged to commodity prices. We saw it in Q3, and here's the proof going forward. For the fourth quarter alone, every single 10-cent change in the price of copper is estimated to impact their cash flow by $80 million.
That sensitivity is the constant risk humming in the background of everything they do.
It is.
And as they pursue this strategy, we should just note their commitment to responsible production seems to be intact. All their sites globally are part of the Copper Mark and Molybdenum Mark assurance frameworks, which is important.
So, what does this all mean for you, the listener? We've just analyzed a quarter that's defined by these completely contradictory forces. You have a company managing a devastating, costly disruption in Indonesia that's going to take years to fix. Yet at the same time, they're leveraging high commodity prices to pour billions into these long-life, high-tech expansions in safer jurisdictions like the U.S. and South America. They're actively, strategically diversifying away from that risk.
They're managing the immediate disaster and the next 80 years of supply, all at once. And if you connect this back to that long-term strategy in Indonesia, which provides the very copper needed for global data networks for the energy transition, there's this fascinating final layer of complexity. That massive Kuching Liar mine is set to produce billions of pounds of copper and millions of ounces of gold right up through 2041.
And they are pouring $4 billion into that project right now.
They are, but FCX's ownership stake in all of that is set to drop significantly starting in 2042. So that raises a really important high-level question for you to think about. How does that impending guaranteed reduction in FCX's ownership, happening almost the minute Kuching Liar's peak production ends, influence the real long-term financial value of that monumental $4 billion investment they're making today? That is the ultimate strategic deadline that FCX has to navigate.